Okay, great. Well, good afternoon and welcome, everyone. I don't know if you heard John say just a couple of minutes ago that we're here on this rainy day, which hopefully in another hour or so, maybe the sun will come out, hopefully, because we have our pickleball Johnnies coming onto campus at 6:30, and we're hoping to play. So we want to just make this casual a conversation, but an informative one. I think we're going to share really great information with all of you, and I hope, again, like I mentioned before, that you're coming with some really good questions, because when we do our Meet the Experts in person, which we just had a couple of weeks ago, and the Wheatley Hills Country Club, the questions I think everybody can learn from, because they're practical information, practical scenarios, and so forth. So let's get started. So my name is Susan Damiani. I am director of gift planning and of the McAllen Society. The McAllen Society is our legacy society. The members include St. John's in their estate plans, and we have a lot of social activities, and it's a wonderful community of alumni, parents, former employees. So if you are not a member of the McAllen Society, maybe after this session, you might consider becoming one. And if that's the case, then please give me a call and we can discuss it. We have two wonderful alumni. They're also McAllen Society members. First person here is John Separano. John is a principal of Madeira Wealth Management, LLC. He provides investment and wealth management advice to high net worth families and individuals, particularly business owners. He was formerly a senior tax consultant at Price Waterhouse, president of Business Blocks, Inc., an accounting and tax firm, and president of Joseph and Company Certified Public Accountants. He also served as an adjunct faculty member at St. John's and University of Florida, where he taught classes in business management and in finance. He graduated with a BS degree in accounting and a minor in economics at St. John's University. We went to college together. I will throw in before, I'll tell one more thing. John received his Master of Taxation degree from Florida Atlantic University and holds the Certified Public Accountant and as Personal Financial Specialist professional designations. And John is a certified financial planner, and he was also on the St. John's cheerleading team. That's a very important aspect. I had to throw that in, John. He's a Johnny through and through, let's put it that way. Another Johnny through and through I enjoy working with as well is Phyllis-Ann Polizzi-Kalenka. She is a partner at Spellman, Gibbons, Polizzi, Troncal, Okay, Troncal, and Trentacosta at LLP with offices in Garden City, New York. Her practice concentrates primarily in the areas of trust and estate planning and administration, as well as residential real estate and nonprofit work for some religious organizations. Phyllis-Ann is a proud a graduate of St. John's University. She received a Bachelor of Arts degree in government and politics and English from St. John's College of Arts and Sciences in 1987. We also ironically went to school together. She graduated magna cum laude, was secretary of the Skull and Circle Honor Society, and received the Outstanding Student Achievement Medal. And in 1990, she earned her Juris Doctor degree from St. John's University School of Law. So we're all loyal Johnnies. I graduated from the Business School College Administration in 1987 with a marketing degree. So we're all here about St. John's, but primarily in generality, we are going to be talking about giving in the new tax era. So I'm going to turn it over to Phyllis-Ann, who will start our presentation. Thank you.
Okay. Good afternoon, everyone. So John and I are going to engage in a discussion to help you understand some common options and methods to make charitable gifts to St. John's University, as well as other entities, but we hope St. John's primarily. Our hope is that these gifts are going to booster the Hearts on Fire campaign that has been started. So I'm going to start by describing the different options. We'll go one by one through each option. I'll speak about the option, describe it for you, and then John will come in and join us and tell us about tax implications of that particular option. Okay, so the first category of gifts that can be made to St. John's would be outright donations. Simplest description of these donations could be a check written in a specific amount, a specific dollar amount, a gift of a percentage of your overall assets, or a gift of a specific asset, such as shares of stock in a particular company or a piece of real estate. A perfect example of an outright gift would be a donation to support the President's Dinner, so that the donation can be used for the needs-based scholarships to support students of St. John's University. I'm going to turn it over to John now to talk about some of the tax implications of making a direct donation.
Well, under the new One Big Beautiful Bill Act, it's a lot to say there. Just let's call it the new big bill here. They're going to be making some changes, some that are going to be applicable and as they were previously to the bill being passed, with some caveats for 2025, but most of the changes taking effect in 2026. So Phyllis may want to keep me on track here, making sure I don't get 25 and 26 messed up here, because we've been talking about this and all these things are brand new, but we're trying to keep them straight, because the planning that you can do over the next 3 months before the end of the year may slightly change on how you go about gifting in 2026 and beyond. And then there's limitations on how long some of these laws are going to be in place from 26 to 30 or beyond. So we'll try to give you some of the implications. You do not have to remember all of these. What I think Phyllis, Ann, and I will do subsequent to this meeting is kind of give you a summary. She doesn't even know this, but we'll try to give you a summary of some of these things. And along with Susan possibly giving you the different types of gifts that you could give to the universities and how it may fit in, and whether they're smaller gifts, larger gifts, while you're alive gifts, or when you pass gifts. Okay, let's get back to the category that we're talking about right now, outright gifts. So right now, when you give a gift without regard to taxes, you're relinquishing some of your assets to the university in whatever form that Phyllis was just talking about, whether it's a tangible gift, whether it's a stock, or whether it's just cash. Now, 90% of people right now, after the tax law changes of 2017, no longer itemize their deductions. And through the end of 2025, that probably won't change too much. However, right now in 2025, there is no limitation on how much you can give, but it could be carried over if you give too much, beyond 50 or 60% now of your, it's right now 60% of your adjusted gross income. So that means if you have $100,000 on your tax return, you can give up to $60,000. Most people can't do that, but I do have a few clients who can, because their outside resources are greater than their income. They're multimillionaires, and whether that's 3 million or 50 million or anywhere in between, they have enough assets where they can give up to their current income. And if their current income was 100 or 200,000, they can give up to that amount. If they give over that amount, okay, they may be limited on what they can deduct. However, you still got to get over a hurdle currently called the standard deduction. Now, the standard deduction right now for single filers in 2025 is $15,000, and for married couple, it's $30,000. So if you're a married couple and you give less, if you give away $20,000 in gifts, St. John's or anywhere else, your church or whatever, you may or may not be able to get that tax deduction on your tax return unless you have additional itemized deductions. So I want to quickly summarize those. There's basically four categories of things you can get deductions for the most part. Either medical bills that exceed 7.5% of your total adjusted gross income. So if your adjusted gross income is $100,000, I'm going to keep using simple numbers here. The first $7,500 you don't get any benefit for. Anything over that goes onto your itemized deduction form to be added to other things, such as the other three: mortgage interest if you still have any, taxes, which currently this year, we'll talk about what's going to change next year, but are currently up to $10,000, and then your charitable deductions. So if those four combined, after some limitations on medical, total more than the 30,000 and you're married, or over 15,000 and you're single, the money that you give in charitable deductions could be beneficial to you. It's not going to hurt you if you can't deduct that amount, because it's not over the standard deduction, whether you're single or married. But if you want to be able to get additional tax benefit, then you may want to consider bunching your charitable deductions in 2025, because there's no limitation, like I said before, other than up to 60% of your AGI. And most people aren't doing that anyway. So if you wanted to do that, you may say, let me give more this year and none next year. And I don't know any school or any church that won't accept money early, or appreciated stock, or a car that you no longer need, or whatever it is. So gifting outright gifts can be beneficial from a tax standpoint, but it shouldn't stop you if you're still charitably inclined.
Okay, thank you. Now, the next category, or the next option that you have available to you for charitable donations, would be through testamentary gifts. Now, testamentary gifts are gifts which are identified in your last will and testament. And the same way you can make an outright donation of a fixed amount or a percentage or a particular asset, you can also identify that donation in that same manner in your last will and testament. For example, your will could say, I leave the sum of $100,000 to St. John's University, or I leave 10% of my residuary estate to St. John's University, or I leave my home located at 123 Smith Street in Garden City to St. John's University. Okay, those gifts, though, do not take effect until after you have died and your will has been probated. So you do have the flexibility, because it is contained within your will, to make adjustments to your will during your lifetime as to what those gift amounts will be. And your will can also be the mechanism by which you can create additional charitable gifts, such as endowed and expendable gifts. And I'm going to talk about those in a few moments. But those can also be incorporated within your estate plan under your last will and testament. Remember that your will only controls those assets which you own in your individual name, which do not have a surviving joint owner or a designated beneficiary. Okay, and I'm going to defer to John to give us a little input on.
I'm sorry, if I could just jump in. I'd like to add, just as a gift officer at St. John's University, with the testamentary gifts, I know they're personal, they're emotional type of gifts, and sometimes the donor may not feel the need to share this information with the charities, and we won't find out until the person passes on. However, if you're single or have, unique situations, it is beneficial to contact the charity, because sometimes the way you may set up some of these gifts in your will may not always be correct, or may not have all the information. And as Phyllis-Ann said, as we get into endowed funds and expendable, that's even more of a reason to contact the charity. So this way, that everything is set up correctly. I would strongly encourage that you do contact the charities and say, I have included you in my estate plans.
Okay,
John?
I'm going to respond to two things. I'm going to go backwards. I'm going to start with Susan's comments first. I'm going to go back to Phyllis-Ann. Being a planner my whole life, not just in title, okay, making things easier for everybody that you're trying to help when you're passed using the testamentary situation is best, just like Susan said. You don't necessarily have to give them the exact amounts, but Susan's job is to try to bring in money for St. John's, let's be honest. And it's not for St. John's, it's for the students of St. John's. So let's not forget who this money goes to. This is to help the kids, whether it's building the building or it goes in the form of scholarships or things like that. She can go over those details with you. But if you give her an indication and then get back with people like Phyllis-Ann or I, we can tell you the best way to do it, not only for the university, but for tax purposes and to make things easy on your executor. So I just wanted to put that out there.
Mhm.
Planning ahead makes everything easier later on to get what you intended in the first place to happen with the least amount of obstacles. And Susan, I, and Phil Sand working together over the years have seen every obstacle can be thrown at us because people didn't plan. So I just want to say that. Let me just ask a couple of questions because we have this great estate planning attorney on here. When people go and put these things in their will, did they get included in their estate because it's in their will before it goes through probate? Is it going to be considered part of the probate? I want you to answer that.
Sure. So it's considered part of your probate estate, controlled by your will only if you own the asset in your individual name, which is why your estate plan needs to not only entail the creation of documents that are going to carry out your wishes, but an analysis of how you own your assets and an adjustment possibly to how you own assets to make sure that assets are going to be subject to the plan that you've created. And if you're using a last will and testament, then you need to have assets that are individually owned that in order for the directives of the will to control anything.
That's exactly right. And thank you for clarifying. I just want to make sure we always got the foundational stuff first. So if you're single, everything that Phil Sand said is probably applicable to you. If you're married and you have joint accounts, those are not going to be considered owned individually because they will be for the spouse that remains, because a joint account will become an individual account. But if that wasn't your intent or you did want to leave it to your spouse while they are still alive, then they can set up the testamentary trust for themselves later on. So we'll get into leaving things by beneficiary designation as an account next, but let's just talk about the tax implications. So while you're alive, because you're not giving anything away, it has no income tax implications. But as Phil Sand just explained to you, when you pass away, those assets will become part of your estate. So typically a testamentary trust is not recommended if you have a large estate. I'll let Phil Sand go into those planning things, which we can then come back to. Go ahead, Phil Sand.
Okay. John, do you want to say anything about estate tax and how charitable gifts under your last will and testament affect your estate tax?
Yes, your estate tax, when it is filed, when you pass and you have certain sources of income and expenses, a final estate tax will be determined by typically the CPA and the estate planning attorney. And if you have a good financial planner, they already know what's going on. They've coordinated this. They will coordinate what is anticipated to probably happen based on what your wishes are. And based on what your wishes are, where assets are, how they're owned, and what types of accounts could create the situation where you have to file an estate tax return just to prove to the IRS and possibly a state where there's estate taxes that you don't owe. So sometimes you just have to file to prove that you don't owe them any tax. So that's another thing. And then Phil Sand may go into portability later on. Go ahead, Phil.
Just want to mention something. So if you make a charitable bequest under your last will and testament or as part of your estate plan, and if your estate is subject to being required to file an estate tax return, the amount of the charitable donation or gift can be deducted from the amount of the estate tax that your estate may owe. So it will reduce your overall estate taxes. And one of the common planning methods when you have a husband and wife whose combined assets will subject their combined estates to estate tax might be to incorporate within their wills or their revocable trusts a provision that effectively says that any assets that exceed the federal or the state estate tax exemption amount will be given to St. John's University as a charitable donation. And that could effectively eliminate state or federal estate tax.
So what that translates to mean is if your estate is so great and that's what you want to do, what you're avoiding is the IRS becoming one of your beneficiaries and making St. John's that beneficiary, for example. Okay?
Right. Okay.
So now Phil Sand's going to talk about gifts by beneficiary designation.
Yep. Okay. So that would be the next or the third option or method by which you can complete charitable gifts. Now, beneficiary designations, as I said before, will control the asset that for which the beneficiary has been designated. And there are certain types of assets where you would set up beneficiary designations. For example, a life insurance policy. When you buy that policy, the agent generally asks you to designate a beneficiary. If there is a beneficiary designated for that policy, that beneficiary is going to be able to collect the proceeds of that policy within a relatively short period of time after your death, because those assets will not be subject to your will. It will not require probate for life insurance proceeds to be paid out if a beneficiary has been designated. So if I have a life insurance policy and I designate St. John's University as my beneficiary, upon my death, St. John's University can contact the life insurance company, present a certified copy of my death certificate, fill out a claim form, and collect the proceeds of that life insurance policy, usually within 30 to 60 days after they've submitted the paperwork, rather than waiting for probate to be approved. Okay? Another type of asset, which is controlled by a beneficiary designation, would be retirement accounts. These could be individual retirement accounts, as well as 401k or 403b accounts. Now, you can name a charity as a remainder beneficiary of those types of accounts. You could say, I leave to St. John's University 100% of my individual retirement account, or you could say, I leave a certain percentage to St. John's University. If you want to include other individuals as beneficiaries, for example, you could say I leave to St. John's University 25% of my account. The other 75% of my account, I can pick other individuals or entities to designate as beneficiaries. Now, you can also use a mechanism called a qualified charitable distribution. If you are 70 and a half and you are already receiving required minimum distributions from your IRA, you can make a tax-free donation directly from your IRA to a charity from your RMD. Okay, so for example, if your required minimum distribution that you're supposed to take out each year is $100,000, you can direct the financial institution that is maintaining your IRA to pay that. If you don't need that $100,000 of income, you could say to your investment advisor, I want that RMD to be distributed to St. John's University. Rather than having that required minimum distribution paid directly to you, for you to deposit into your account to write a check to St. John's University, if the distribution is made directly from the financial company to St. John's University, it can help you minimize some of your own income tax consequences. Okay. Now, there are some limitations as to how much of your RMD you can donate to a charity per year. And for 2025, the limitation is $108,000. In 2026, that limitation goes up a little bit to $115,000. But it is a very useful tool to complete a charitable donation with less tax consequence to you, because you're not actually deemed as having received the income, because the payment is going directly from the IRA to the charity. Now, a last category of beneficiary designations as a method to make a gift to a charity would be accounts that have a designation on it known as either a TOD, as in Thomas Oliver David, or POD, as in Patricia Oliver David, or an ITF, okay, as in India, Thomas, and Frank, okay? TOD means transfer on death. POD means payable on death, and ITF means in trust for. Now, those designations can be placed on any number or any different type of accounts. Like, for example, bank accounts can be placed on CD accounts, savings accounts, money market accounts. They can also be added to investment accounts, non-retirement investment accounts. And the benefit of those designations is again, that the charity will receive that asset or a portion of that asset very quickly after the death of the account owner without need for that asset passing through probate. Okay, I'm going to turn it over to John to add anything that he might think is necessary regarding tax implications.
Absolutely. When somebody goes to an estate planning attorney, and let's say you did it 8 years ago, Phil Sam, I'd love you to comment on this. I've seen different attorneys say different things, but for the purpose of being objective and independent, sometimes people's wishes change.
Yeah.
So they set up these things. Let's say you went to the attorney back in 2018 or 2020, just before COVID or whatever, and some things have changed in people's lives a lot in many cases over the last 5, 6, 7 years. And I'm not even talking about the laws. I'm just talking about what you want to have happen or who gets it. Or if somebody died, somebody fell out of favor, somebody new came into favor that you want to leave something to, or an institution for that matter. So let's talk about taxable account, not retirement accounts. I don't want to get to what Phyllis Ann was talking about with retirement accounts. So on taxable accounts, it is very important to update those things, because if you had them simply in a will, okay, and you had a specific dollar amount, and now the dollar amount wants to change, when you put beneficiaries on taxable accounts, and quite frankly, even retirement accounts, they will supersede anything you put on your will. So if you put in your will, I wanted $100,000 to go to St. John's and $100,000 to go to my granddaughter, and now you've changed your mind on those amounts or who you're going to give it to, you could simply change it on those accounts. It will cause confusion. It may even cause frustration, because if those people come and you handed out a will or told them about what you were going to do, and now it's changed and they find out after the reading of the will, but now it's been changed on your accounts, you may want to coordinate that so there's no confusion. But sometimes people go, well, I don't want to go back to my attorney. It's always best to tidy up all these things with bows and get things cleaned up and coordinated, in my opinion. And I don't get anything out of that from a legal standpoint. I refer people to go back to their attorneys. However, for small little changes or something like that, we recommend that not only do you change it on the accounts, but you go back and make adjustments in your wills or documents. Now, you can also do that in living trusts. Now, the beauty about doing it in living trusts is that many times they don't have to change the whole thing. A lot of times, unless Phyllis Ann tells me otherwise, you don't typically make changes to wills. You just redo them, typically. Trusts, you make changes to a trust in just the sections that you want. So I just want to bring that up. Now, in terms of retirement accounts, and we talked about in particular giving money away when you get older. Okay, when you're 70 and a half or over, do not ask me how they came up with that. Somebody was in Congress and said, I want to do it because I'm over 70 and a half, and they come up with this date. It's a cockamamie thing to remember, but all of us professionals finally got it ingrained to us until they change it again. But what it says is you're able to start reducing your taxable income for things that prior to turning 70 and a half that you'd have to write a check for and try to itemize. The beauty of doing qualified charitable distributions, which means out of retirement accounts, typically just out of internal, IRAs, most people wind up, when they're retired, typically rolling over their 403Bs and 401Ks into a self-directed IRA. There's some reason sometimes you keep them separate for asset protection, but for the most part, you can roll them into an IRA. So let's say, I'm going to use Phyllis's numbers, that you had $100,000 required minimum distribution. Let's say you're past the age, and that age keeps changing, but let's say you're already past that and you have to take out your required minimum distribution of $100,000. Whether you want to give away $5 out of that IRA, or you want to give the whole thing, or anywhere in between, there is one important thing that we have to bring up that Phyllis didn't get to, but because I deal with this every day, is this: it's the ordering in which you do things. So you have to take out your required minimum distribution before you do other things. And if you want to give away money out of that amount that's required to be taken out in a tax year, you have to take that out first. So if you took out a total of $120,000, the last $20,000 will not be currently back tax beneficial to the that you gave to the charity. It has to be before you get to the $100,000 in that year, whether you do it at the beginning of the year, throughout the year, or by the end of the year. You have to set up that charitable distribution qualified beforehand. So if you want to give away 20,000 out of that 100, that is to be distributed out before you get to the 100 in total, let alone if you go past it. And the benefit is this: dollar for dollar, it'll reduce your taxable income by the amount that you give away. It is the best way to give away money and get a direct tax benefit, because you don't even have to itemize.
Okay, thank you, John. Now, the fourth category of gift options would be to create an endowed gift. And an endowed gift can be created during your lifetime. It can also be created under your last will and testament, or by your irrevocable trust. You can direct the creation of it to take place either during your lifetime or after your death. Now, what an endowed gift is this: I donate a principal amount of money, $50,000, to St. John's University for the use in establishing a scholarship. Okay, that $50,000 is given to the university as principal. That $50,000 then is invested, and the income that is generated by the investments is what will be paid out as this scholarship to the eligible student beneficiary. Now, an endowed scholarship is just one example of an endowed gift. And the great thing about endowed gifts is that they can continue in perpetuity because the principal will remain intact and reinvested every year to generate a stream of money. You can not only create an endowed scholarship, you can create an endowed professorship. And St. John's University would require a minimum contribution of $1 million to create an endowed professorship. And what that will do is that $1 million will be invested to generate an income stream to cover the salary of the professor of a particular department. Possibly you would choose it. You have the right with an endowed gift to name it, to select a purpose for it. Same thing, you would have that same right with an endowed scholarship as well. Endowed scholarships, by the way, a minimum contribution would be $50,000 to create one. You can also create an endowed chair, and that would require a minimum commitment of $2 million. And you can also create an endowed deanship, which would entail a minimum contribution of $5 million. All of these types of endowed mechanisms preserve the principle of the initial gift. And it is the income that is generated by that initial gift, which is awarded as the scholarship or used to pay the salaries of the individuals for whom the position has been created for. Now, the benefit of that to St. John's University, for example, if you create an endowed professorship, you are now providing a resource to be used to pay the salary of that professor, so that St. John's University is relieved of the obligation to pay the salary of that professor, and then St. John's can then dedicate that money for a different purpose. Okay, I'll turn it over to John. See
If I could just interject one
Go right ahead.
couple of tidbits on that. First of all, the minimums that Phyllis Ann was mentioning, that's only for St. John's University. Other charities and institutions have different minimums and different requirements. Other schools would probably be asking maybe even higher amounts. I know at some schools they don't start endowed funds. The lowest is like 100,000 or 200,000. And some of these professorships, deanships, and chairs the minimums do change per college. So that's kind of like an estimate. And when you do give the gift to establish this endowed fund, the university will hold the money for 1 year. That's just to build up the interest, and then the interest is awarded. It's around 4.5%. Usually of what is awarded from that endowed fund. And like Phyllis Ann said, it could be in perpetuity, or sometimes people pledge, a certain amount. But it's something that is really an amazing gift, because it's not once you make the gift, that's it. You can continue to contribute towards it. You can add, to it every year. Sometimes people, when they want to honor a person, a special anniversary, a special birthday, or something like that, the whole family or friends will add to that fund by gifting to that particular fund. So
okay, I want to respond again to Susan first, then go back to Phyllis Ann on endowments. Okay, just to help clarify things. Number one is I do want to answer these questions while it's top of mind, which may be topical to what we're talking about with two participants. Right. One is
and I know also we have a question, but we're going to hold the questions, Hank, to the end of the discussion. So we didn't forget about you.
Okay, I'm just making sure they know that.
Yes.
I've been gagged before myself. I understand. Anyway, sometimes by Susan. Anyway, let's just talk about endowments. First of all, we don't want to insult anybody and say, hey, if you don't have $1 million, you're not important. Okay, please trust us. That's not it. Everybody has different resources. Everybody has different capabilities. Whether you're giving us $50 or $2 million or anywhere in between, we'll help you find a place that helps St. John's. okay? The reason that the endowments are set up with minimums on it is because they're administratively a pain in the neck to set up and to maintain, and then there's costs associated with them by the institution and the custodians that we have, and then to administrate them and dole them out over time is important. So keep in mind, and like I said, Susan will hopefully be able to send you up a follow-up of the different things, and you can find what box you'd like to help out. And as things change over time, maybe you can build up funds. Susan made an example of, maybe you can get together with your family. Maybe there's multiple legacy people in your family, from a grandfather or grandmother down to a grandchild, 3 or 4 generations, and everybody wants to help each other out. Maybe the younger people can only put in 5 or 10,000 or something, in the early stages, where the grandparents could put in 100 or 200,000, and collectively you can form like a legacy foundation for your family. So work with Susan to figure out how to best figure out what box suits you and best can achieve what you're trying to help St. John's with. So I just want to put that out there, Susan. Okay.
Thank you.
Endowments usually are really hard for people to set up while they're alive. And the reason is most of the St. John's people are really hardworking people. Some have done extremely well. Some have become multi-millionaires and can afford to do these much larger numbers. But many of the people can afford less, or $500 a year, or $1,000 a year, or up to $10,000 a year, whatever it is. Some of you are still working, taking care of kids or grandchildren, whatever it is. Some are retired. There is a place for you to help out St. John's in there. And from an endowment standpoint, that is just one type of way to give. Keep in mind, we're not emphasizing it. We're saying, don't forget there are these things if it's something you didn't realize that you could do with us. Susan is very willing to help you walk through those steps. The endowments also help you reduce your estate. So when you set that aside in your will, and you're already maybe over, which may seem impossible to some people, but there are people out there, and I have a number of clients like that, not all my clients like this, but I've got a few where either they are individually, singly worth over 15 million, or as a joint husband and wife are worth over 30 million today, which are going to be the estate tax exemptions come January 1st. And with those people, they do not want to give any of their money to the IRS if they can avoid it. So they're trying to figure out the charities in which to do that. And like Phyllis Ann said earlier, anything over my exemption amount will go to my charity, or multiple charities for that matter. And the other thing I wanted to emphasize is that when you give things away in your, when you have a choice of where to give away things from in your estate compared to who gets it with their heirs, heirs are 10 times going to be happier to get things from a taxable account, because on the day that they get it, there'll be virtually no tax. If you have a Roth account and you're familiar with that, if you're not, I'm going to be sending you something out so people can ask me questions. They get no tax and will not get taxed for 10 years. But if you have it in an IRA, whoever gets the IRA other than a non-for-profit could force it into a higher tax bracket. So the first place to get money out of, if you've got a choice of 3 accounts, taxable, Roth, or IRAs, or retirement accounts, it's to get the charities money out of the IRAs, because then the IRS gets cheated out of anything, so to speak, legally, because the charities will not have to pay a dime, and your estate loan tax won't have to pay a dime. So hopefully that makes it simple.
Yeah, if I can add another thing, thank you, John and Phyllis Ann. With these amounts, I know sometimes people are overwhelmed at first when they hear, 50 or $1 million or 5 million, but you can also make a pledge. You don't have to do it all at once in the first year. You could pledge over 5 years. The other thing is, in fundraising, we call a blended gift. So people, donors, prospective donors, will come to me and say, I really want to establish a scholarship fund. So maybe I would start it, at 25,000 or at 50,000, and then they can see, the good that they're doing with this fund. But they really wanted to contribute more, but they're, like John said, maybe their circumstances won't allow them to do it now, but they will include that fund in their estate plans. And then when they pass on, then they can give the additional 50,000 or whatever it is that they wanted to achieve that can come later at the end of life. So, and also when people come to me and want to make a planned gift and they make a verbal commitment, Sometimes over the year, 2 years, or a life event, they'll come back to me and say, you know what, I've learned a little bit more on what I can do and what I want to do. And then they'll come back later and say, you know what, I'd like to establish an endowed fund. So sometimes it's not always established right away when you make that commitment to make a planned gift to the university.
Okay, and with that, we're going to talk about expendable gifts next, because this requires a lower donation threshold than the endowed gift. Now, an expendable gift can be created during your lifetime. It can also be directed under your last will and testament to be made after you've died, or in your trust to also take effect either now while you're living or at a later time. Now, what an expendable gift is a gift of the principal donation that you are making to St. John's University. There's a minimum commitment of $5,000 for St. John's University. The expendable gift can provide an immediate financial support for a particular project or a particular need. Unlike the endowed fund, where the principal remains intact to generate an income stream, the expendable gift is, if I gift to St. John's University $5,000, I can specify to St. John's University, I want this to be used for this particular purpose in memory of this particular individual, and I want it paid out either as a lump sum this year as $5,000, or perhaps maybe $2,500 this year, maybe $2,500 next year. Once the expendable gift is paid out, it is completed. It doesn't go on in perpetuity the way that an endowed gift does, but you're not limited as to the number of expendable gifts that you can make. The only limitation is that there's a minimum of $5,000. John or Susan, I don't know if you want to interject on the
I think
gifts.
Also, I didn't mention for endowed and as well as expendable, you can name these funds, the donor can name them, so you can really personalize this type of gift. Also, I know sometimes people are leery of charities, like, where is this money going? What's great about the endowed fund, it goes into a restricted fund. Okay, that's that account to be used for that criteria. That is all spelled out in an agreement letter, which you sign and the university signs, and they have it on file. So especially if it's something, testamentary that this is not going to kick in till after you pass on, you could have peace of mind that the university, like I say, has their instruction manual per se of they know exactly how to perceive and how to carry out your wishes and where to designate the funds, because it's all spelled out ahead of time or at the time you make the gift. So I think that's another plus when you're setting up these funds. And as well as the expendable, that's all spelled out as well. But like Phyllis Ann said, that is expendable. It's in and it's out. The endowed is held in perpetuity and the principal is not touched.
Yeah, so for example, if you felt that you didn't have enough money to set up an endowment fund and you want to do the expendable, something to keep in mind is that the expendable amount, like Susan just said, will be used that year for whatever your purpose is that fits into a category that Susan says, here's the different things. I want to give it to the basketball team. I want to give it to a scholarship, whatever it is. She'll let you know what categories those are within the category that you're talking about, and then you can name it and all that stuff. Keep in mind, though, when that is done, there's nothing being carried over, which is a little bit different than an endowment. Now, if you want to leave money that's going to leave a legacy, and you want to pay something along the way, it's like, let me just throw $2,000 at sports or something, but I want to start building up an endowment or leave it. Talk to her about the way you can set up an endowment to get up to $50,000. Maybe you got to give $10,000 away there. Maybe you don't want to give anything expendable. You can pick and choose here. There's so many things that you can do. But if you want it to be some form of a legacy, then you'll have to figure out a way with Susan to build it up over a period of time. And I'm not going to tell her what to do to break the rules, but you say, I need 6 years, she'll work with you or something, whatever. But my point is, we're trying to help the school and ultimately forget about this. Isn't about the money. This is where it's going, to help the school give better services and help children that otherwise would not be able to come to our school. That's the blessing here. So The expendable amounts are no different than the endowment amounts. In the year you give it or the year that it comes out of your estate, it will be a gift and it will be tax beneficial when that happens. I want to go over some things because I started out at the beginning, but I haven't made a couple of distinctions. This year, there are no limitations or restrictions on what you can give away other than you either have to be able to itemize like I went over, so I won't go over that again, but up to 60% of your total income, adjusted gross income. However, in 2026, some of the rules have changed. One's beneficial to the people who give smaller amounts. You as an individual can now get as a deduction without itemizing $1,000 starting in January, okay, off. So if you give $1,000 or less, you can deduct it. If you give $1,000 more and can't itemize, you're still able to just still give the $1,000. If you're married, double it to $2,000. If next year you want to give a more substantial amount away than just that amount, okay, next year you got to get over another hurdle. And the hurdle is 0.5% of your adjusted gross income, where this year there's no hurdle to get over other than the standard deduction. Next year, if you go to itemize and you give this money away, you got to get over first 0.5%. So again, if you have adjusted gross income of $100,000, the first $500 are not deductible. In the scheme of things, if you're giving away a lot of money, the $500 is no big deal. And quite frankly, you'll be able to get the deduction on the front page anyway. So don't make that a big deal. This would only be a big deal if somebody was giving $1 million away, but you'd still get a huge deduction. So my recommendation is this, is that for this year, if you want to give a substantial amount of money away and you can itemize, give that money away. If you want to give a large amount of money away because this is a big tax year for you, you just got a big bonus if you're still working, you just retired, you're not going to have any more wages, and next year your income is going to go down, you may want to do a donor advised fund and get a big deduction this year, but then pay it out to St. John's as you want or any other charity over the next 2, 3, or 4 years. There's no time limitation on when you have to take money out of a donor advised fund. It is the only IRS deduction that you can get that you literally don't have to give that gift out immediately. So if you want to do it over a couple of years, you could. That's something a lot of people don't think about. So what that means is next year, there's something else that's important to know. For those of you living near St. John's or in the Northeast or in a state that has high income taxes, the limitation on taxes that you're allowed to take through the end of this year is $10,000. That's real estate taxes, income taxes, any kind of taxes that you're able to deduct currently. Next year, it jumps to $40,000. So for people who are, making under $500,000, because there's a phase out limitation and it goes from $500,000 to about I think it's $550,000 or $600,000, you get phased out, you can't even do this, you go back down to 10. But if you're making under $500,000, you are able to take up to $40,000 of taxes. So the people who would be there, let's just say real estate taxes are $20,000, and you had some income taxes that you paid to your state, another $5,000. Now you're at $25,000. To get over the hurdle next year of $31,000, all you got to do is have $6,000 in charitable deductions. With this year, you wouldn't be able to even get it. So next year would be a good year, okay, to really think about charitable deductions to do that. What were we going to say, Phil, Sam?
John, the final legislation that was passed with respect to the SALT tax did make it retroactive for this year. I know prior to that, they were talking about making it effective.
I apologize.
Yep,
that's correct.
Yep. So that's what John was referring to when he was talking about the cap.
But you don't have the 0.5 cutoff that you're going to have January 1st.
Correct.
So this year is a huge year where if you're in a very high taxing state, sales tax, income tax, all these kinds of things that are deductible right now, this is a year that your charitable contributions would go a lot further for tax purposes, not only to help out St. John's, but to help out yourself reduce your taxes. So if you were charity inclined, you're going this year versus next year with that retroactive. I forgot about that because that just came out in the last 2 weeks. Since our last expert panel, it came out, as a matter of fact. I'm glad you said that. Then we're able to now help our clients and accelerate making those deductions. Because if you were going to do it in January or February, you might as well do it now and save on this year's taxes versus waiting until next year, which won't be a tax thing you're really thinking about until the middle of the year or the end of the year. Me being a planner, Phyllis being a planner, and Susan trying to help you become a planner, playing a planner here. We're trying to get your dollars to go further on where you want it to go. That's what this is all about, today's meeting. And by the way, I'm talking to you about taxes, but to me, it's an integral part of your investments. We didn't even get in, and we have no time today to talk about it, but the type of investments that you give away, whether it's cash or appreciated stock. Susan and I, for the last 6 months, without mentioning names, have been trying to get money out of a custodian to try to simply get a donation to St. John's. And all it is one appreciated stock. But let's assume it goes very simple, and it should, quite frankly. You will not have to pay the tax on that otherwise you might have to pay if you were to sell it and then send it off to St. John's. Here's a way to get that appreciated stock of something that you have for a very long time and get it into St. John's hands, because when they sell it and use that money, there's no tax on it. So that's a big thing I just wanted to bring up.
Okay, and that actually is a great segue into the next category, which is charitable gift annuities.
Right.
So what is a charitable gift annuity? Well, it's basically a contract between the donor and the university, whereby the donor donates a minimum sum. The minimum sum to create a charitable gift annuity with St. John's is $10,000. The donor donates that sum of money to the university. It can be cash, it can consist of other assets, it can consist of securities. Now, that donation is then taken by the university and invested, and the university, as part of this contract, will pay out a fixed payout to the donor for the rest of the donor's life. The amount of the payout is going to be based upon the age of the donor at the time that the gift is made. If there is any balance that remains in the charitable gift annuity at the donor's death, that balance will go to the university. But the beauty of the charitable gift annuity is that it allows you to actually transfer long-term, an asset with a long-term capital appreciation to the university to avoid you, the donor, having to pay capital gains tax on the sale of that property or that asset, or avoids the need for your estate to have to include that highly appreciated asset in your estate for estate tax purposes. John, I don't know if you want to add, or Susan, you want to add anything about charitable gift annuities?
No, I think you summed that up very well. Same thing. The idea is to save on taxes, and everybody's going to be in different tax brackets. I think with the amount of time we have left, let's open it up to questions, because we've covered like 95% of what we need for charities.
Hold on 1 second. I think we want to talk about donor advised funds, though, Susan. Didn't you want to talk about that in foundations?
A little bit more? I covered that a little bit
of it. Yeah.
Well, let me give a let me give a quick
I think so too.
Summary. Okay, so there's donor advised funds and foundations are two other methods to make charitable gifts. There's a difference between the two. Okay, a donor advised fund is a fund or an account that's operated by a 501c3 entity known as a sponsoring organization. Now, a sponsoring organization is usually tied to an investment company, for example, Charles Schwab or Fidelity. This sponsoring organization maintains this account. A donor would open an account with that sponsoring organization, make the donation into that account. The donor then can make requests as to how much it will be distributed from that donation, when it will be distributed, and to whom it will be distributed to. The donor has the right to request specific charities. Now, the sponsor that runs the organization has to approve the request made by the donor, but chances are the sponsor is always going to approve the request, because otherwise they'll have a negative reputation in the donor advised funds area.
Let me just say this, Phil, just one interjection there.
Sure.
Typically what happens with those, they will do everything that Phil Sands said, but the easiest way to confirm all that is what the donor advised fund is looking for are charities that they find are financially stable, which is the same thing you would want, okay, to make sure that those funds don't get absconded, they don't have high payouts to people opposed to the people, like to the CEO or whatever of it. So they're there to protect your investment. And usually you can say, who do you want to give it to? Then they'll go, no problems, so you won't have any problems.
Okay. Now, the difference between a donor advised fund and a foundation is that a foundation is a separate 501c3 entity that the donor would create and that the donor would also fund. Now, the donor ordinarily has full operational control over a foundation, or they bring family members or friends into that foundation to run it so that they have influence in terms of determining where the donations are being distributed and in what amounts. It is more complex and more costly to establish a foundation. It is more costly to administer a foundation. You need to work with qualified attorneys and accountants and financial advisors. And the downside of foundations is that foundations have to distribute at least 5% of their net assets each year, whereas a donor advised fund, there is no requirement that distributions have to be paid each year. Okay, so that's just two of the main, some of the main distinctions between a donor advised fund and a foundation.
Plus
Yeah, and
with
I
the
typically,
foundation-
myself and my firm.
foundation- Oh,
I'm
sorry,
go
John.
ahead.
You
Go ahead.
Sorry, good.
Well,
John.
I'm just going to say because of the costs associated with setting up and maintaining,
Mm.
foundations usually don't make sense, what we've seen, unless it's at least $500,000.
Right.
I was just going to say that. And also I've seen, our donors that have foundations, the reporting and the paperwork it's a lot,
Yes.
where the donor advised fund is a lot easier. And
Mhm.
we're seeing that becoming more and more popular with donor advised funds. I know the last thing we were going to talk about is trusts, and I know we're running out of time. We are going to have a power lunch that's going to cover trusts. There's so much involved with it. But, I don't know if you just want to say a couple of things,
Sure.
Suzanne, about
Sure.
the three different types of trusts.
Can I make people laugh? Because it just happened to me today.
Sure. What?
My brother, who is not on this phone call, came in this morning and said, Johnny, I need to set up a trust. I go, why? He goes, because I don't want to pay any capital gains. I go, who told you that? So there is a lot of misconceptions about
Yes.
trusts and helping people understand it. The primary person of a trust is to set it up for the people you don't trust can handle the financial affairs themselves. And therefore, you typically set it up to give very explicit instructions for unique circumstances. The other main reason to set it up, and Phil, please correct me on anything, is to minimize the process of probate and its involvement. And it makes things go a little bit more streamlined. It also processes beneficiaries, whether charitable or individuals, getting what you want them to do to get it faster.
Okay, so I'm just going to give a quick summary. So you can create lifetime trusts, can either be revocable or irrevocable. Okay, and you can use the mechanism to make a fixed dollar gift, a fixed percentage gift, or a gift of a specific asset, the same way you can with a last will and testament. Under revocable trust, the gifts can be made during your lifetime or after your death. Under irrevocable trust, the two most common types of irrevocable charitable trusts are known as a charitable remainder trust and a charitable lead trust. Now, the distinction between the two is this. With a charitable remainder trust, the donor contributes the money to the trust. The principal that is contributed is invested to generate an income stream. With a charitable remainder trust, the income is paid out every year to a non-charitable beneficiary. When the trust term ends, any remaining principal in that trust will then be distributed to the charity. A charitable lead trust, on the other hand, is the exact opposite. The principal is also invested to generate an income stream. The income is what is paid out to the charity during the trust term. And at the end of the trust term, when the trust ends, the remaining principal balance is what is going to be distributed to a non-charitable beneficiary. That's it.
Wow, that was good.
Okay.
It's just,
John?
it's a lot to digest for sure.
Yeah,
sure.
But it is another great way to gift to the university. Obviously, with the trust, you would have to have an attorney involved. So therefore, the minimum for that is about $250,000 to $500,000. Sometimes you can achieve sort of the same thing by doing a charitable gift annuity.
Yes.
Rather than going through a trust. And then with the charitable gift annuity, you wouldn't need the attorney, but you would be signing an agreement, and the university would sign that agreement as well.
Mhm.
So now, I don't know if we
Questions?
have anything else to close on. We'll turn it over. I know Hank has been waiting patiently for us to answer. Hank, please share your question with us.
Hi, first of all, thanks for a great presentation. Can you hear me?
Yes.
You certainly
Yes.
can. Thank you.
I just want to make sure I understand the question about reducing your tax liability this year. So here's what I came away with. First, is the 108,000 deductible limit for a single or a married person, couple?
I think you're referring to the qualified charitable distribution, right, Hank?
Yes.
Yeah, the 108,000 should be for a single individual limitation.
Okay, so as a married, so therefore, I'm coming away with it's smart for every donation I give, send them out of the RMD. First step.
It would
Yes.
reduce your taxable
Mhm.
income. Mhm.
All right.
Then, second, if I'm giving stock away that have large capital gains to charities, that's the second way. Because if I can pull all the money I need to give away at the RMD, that's the most desirable. Then phase two would be move into deductible taxes that have high, high growth,
Appreciation.
high
Right.
appreciation. And
That's
then
correct.
third, we should give to our children a $16,000 tax-free donation every year.
It's,
It's currently up to 19,000.
right. That's known
Currently,
as the annual exclusion.
Yeah.
all right, and that has no tax implications for
None.
them or parent.
None.
Okay, so you can be very clear. I understood everything.
Great.
How's he do, guys? Does he
He
get an
gets an
A
A.
on his
He
report
gets
card?
an A.
You get an A, Hank.
Yeah. John,
Very
can
good
you hear me?
comprehension.
Yeah, Hank, just reach out if you want to go over specifics. I'll be glad to respond with an email. Okay?
Thank
Susan, it
you.
looks like we have more questions.
Okay.
Yes.
John, can you hear me?
Yes.
Okay, how does the QCD work? I have my plan to put some stuff in the QCD,
Mhm.
and I want to use it to effectively lower my tax by doing qualified distribution.
Okay, I want to make sure that I understood what you said because the words that you used were a little confusing to me.
Yeah.
You said you put the QCD into something. Usually a QCD is a distribution directly out of your IRA, for example,
Right.
to, for example, St. John's. It goes directly to them. So what you do is you call up either your advisor or your institution that you have the IRA with. He said, I want this amount going to this institution. If it's St. John's, Susan will tell you exactly who to send it to, what the name is, what the routing number, all that kind of stuff. And it needs to go directly from the IRA to that. You can't get a check for it.
Right.
Now, there are instances where I've seen that happen, but you got to be really careful because it has to say so such and such amount for the benefit of St. John's from Frank's, IRA,
Okay.
kind of thing.
Yeah, it's better
And
that it
is-
goes directly from the IRA.
Right,
Yeah, it
and
should
if
go
it,
directly.
if it goes right now, so we got 3 months before the end of the year,
Right.
can that designation change? And it went into my account, but I really want to be able to treat it
Wow.
basically as an RMD,
Mhm.
so good.
You've
Well,
already
it's-
received it
He's
then.
already
Here's
received
how
it.
here's how
Yeah.
it works. It's not what your advisor says, it's what you actually do. So let's make believe your RMD is 50,000 for the year. Okay, not high, not low, but 50,000. And you want to give away $20,000. Have you taken any of your required minimum distribution yet this year?
All of it.
All right, if you've given all of it, you can't get any more tax deduction or reduction of your taxes this year. However, it will reduce the balance in your IRA. So come January, you will have a smaller required minimum distribution because your balance will be lower, but you won't get any more tax benefit. That's why I was saying earlier, when you want to do qualified charitable distributions, you need to do it for the tax benefit to do it before you take out your full RMD. If you take out beyond your RMD, it'll reduce your IRA, which will reduce your estate and reduce your future RMDs, but you'll get no current year tax benefit. So the
Okay.
timing and the order in which you do things going forward, try to get those QCDs done first.
But you also rolled it, you put
already
it
took it
into
into
your
your own
savings account or wherever,
Right,
right? So he already rolled it into his
right. So you'll
personal
be
account.
treated.
Well, once he
So
took
he's
it out-
asking, can he take it out of his personal account?
No,
And
No.
now, once it's distributed, that's it, right? You can't reverse it.
personally, Susan doesn't care where the check comes from. But for me, I'm just saying, if you want to get a tax benefit, you need to take it out first before you finish taking your full RMDs. So next year, if you're thinking you want to give away so much money of your RMD, make sure you do that early in the year so you don't forget, and then you get the tax benefit.
And have the financial advisor pay it directly to the charity as opposed to
That's
paying
exactly
it to you
right.
first.
So at
That's
this
exactly
point, if
right.
you wanted to give a gift to St. John's, you'd have to do an outright gift and you'd get a charitable deduction for
Every
it,
time I
right?
open that door, she jumps through it, Susan. Anyway, all right, who's next on questions?
Anybody else have a question?
I think Hank might have another question. Oh,
No, we have to take his
hand is up.
hand
Okay.
raise. Yeah, no, I thought there was someone else, no? Anybody else? Quiet, everybody's quiet. All right, so I hope this was very helpful to everyone. Certainly Phyllis Ann, John, and myself are available for any questions down the road that you may have when you're maybe putting your plan together or organizing all of this. As Phyllis Ann mentioned, and as you could see in my background, St. John's University is in the middle of a capital campaign. It's called Hearts on Fire, which is comes out of a quote from St. Vincent de Paul. And if you want to make a gift and you make a gift this year and beyond, you'll be a supporter to that campaign. You can also make a planned gift, and if you document it through a gift annuity agreement or you have a scholarship agreement, that's documentation that we can document that gift for the capital campaign. And also this past year, anyone that was trying to get season tickets and wanted to maybe see if they could get a better seat, they made contributions to the athletic program, and that was counted towards their season ticket points. So there's a lot of different ways, and when you give, there are benefits. Like I said, joining the McCown Society is a great community. And for me, when I work with anyone, it's not transactional, although I know today it sounded very transactional. I just want to leave you with, it should really be transformational. I really want to see that you want to support our wonderful St. John's University, but I hope it's given back to you tenfold and you feel really good about it and it transforms your life, not only the lives of our students. So thank you so much for your time. Again, we're always here to help you as a resource. We're all St. John's alums and we're all here to help each other. So thank you so much.
Hi,
Have a
Susan.
wonderful afternoon.